Hello, friends. This is Ankit Kanodia, co-founder and partner SmartSync Investment Advisory Services. We are a SEBI RIA firm advising retail and HNI clients on their equity and mutual fund portfolio. Welcome to the third episode of Leaders Ka Falsafa, a new initiative by Mission Smile community to deep to dive deep into the top management or promoters of several businesses to know more about their journey, their struggles, their victories, and their vision for the future. While we have all Mission Smile members in the audience, but for the investors who will watch the recording and who may not be aware about Mission Smile, let me just spend a couple of minutes on Mission Smile. Mission Smile is an investment education platform for serious retail and HNI investors of India. Started with humble beginnings 3 years ago. Today, we have close to 6,000 investors learning from our Mission Smile platform. Mission Smile stands for Making New Stock Market Investors Learn It Through Engaging Research. We also have a mobile app for both Android and iOS phones. Just search for Mission Smile. Before I introduce our amazing guests for this session, as a SEBI RIA firm, I need to read out the standard disclaimer. Neither me, Ankit Kanodia, or my company, SmartSync Services, has any holding or recommendation on the business we are going to discuss today. And neither me nor my company has got any compensation from the management to host this session. With the regulatory disclaimers out of the way, I'll introduce our guests now. Mr. Ishan Gupta and Mr. Sambit Gupta are both part of the promoter family and joint managing directors of Gateway Distriparks Limited, which is a market leader in India in container-based multimodal logistics, operating container freight stations, inland container depots, and transportation through a fleet of trains and road trailers. They are also directors in Snowman Logistics Limited, which is India's largest cold chain logistics service provider. I've kept the introduction of our guests short so that we can let both Mr. Ishan and Mr. Samvit talk more about them and their business. So over to you, Ishan and Samvit. If you can both start with an opening remark, that would be great.
Thank you, Ankit. Firstly, thank you for having us on your show. I think it's a great format and wish you all the best as you create more and more episodes. A little bit about us and about our company. I'm Ishan Gupta. This is my brother Sambit Gupta. We run Gateway Distriparks Limited, which is into multimodal transportation. We have container freight stations, inland container depots. We have our own trains, and we do a first and last mile by road. And through our subsidiary, we have Snowman Logistics, which is a cold chain business, and we operate minus 25 to plus 25-degree temperature control services for warehousing and distribution across the country. So I think we can, Ankit, however you want to start the questions, we can get to it.
Sure, thanks. So we'll straight away start from the first question. Let's start with the origins. Tell us a little bit about the history of Gateway Distriparks, how it started, some important milestones along the way, major successes and failures, and the different business verticals you kept adding as you moved along. Try to be as detailed as possible. It will help us to be more informed about your business.
Right. So the company started in 1994. We, apart from our logistics business, as a family, we are also into paper trading. We import newsprint paper from Canada, Europe, US, and we sell to newspapers in India. So as an outcome of that, back in 1992, we imported paper which used to come in brick bulk form earlier. We got it in containers. And then we faced a lot of issues with clearing those containers, handling them. There was no proper infrastructure. And from that, we realized that not only do we have a need, but other importers and exporters also face this challenge. And the idea of Gateway was born. So we started with the first container freight station in Bombay. And from there on, we have grown. In terms of milestones, I would say, after starting and after the first facility, when volume started to kick in, In 2005 is when we went public, and that helped us with the faster expansion from there on. So we got into the rail business. We got a container train operator license, category 1 license, which allows us to run our trains all over India. And at the same time, we found an opportunity and we acquired Snowman Logistics. And organically, we kept growing our footprint as well with more container freight stations at the time, which was a booming business back then. So we grew in Chennai first and one by one in other locations. Uh, that's been the story so far. As of now, we are into rail business. Primarily, that's the growth driver in our group. We have inland container depots at Gurgaon, Ludhiana, Faridabad, Kashipur, which was a recent acquisition, and Ahmedabad, and container freight stations at Bombay, Chennai, Cochin, Vizag, Krishnapatnam. So that's been sort of the growth story. And going ahead, we have some expansion plans which we'll get to over the course of our discussion.
Thank you so much, Ishan. So I'll straight away move to the next question. So the group companies, Gateway Distriparks Limited and Gateway East India Private Limited, were amalgamated with Gateway Rail Freight Limited in December 2021. And the name of the company was changed from Gateway Rail Freight Limited to Gateway Distriparks. Maybe you can expand more on this in terms of what were the rational synergies and what we have achieved so far with the amalgamation, and what we want to broadly do in the future with this.
Right. So Gateway Distriparks was the parent company, and Gateway Rail Freight was the subsidiary which was into ICTs and rail transportation. The parent company ran the CFS business, and we found a lot of synergies, and it made sense to merge these entities. Gateway East India was only one single CFS in Vishakhapatnam, which we had. So yeah, the rationale for doing this group amalgamation was basically there was a lot of synergy. We had common customers, we had common cost centers. The management was doing similar work, and we felt that it would be beneficial to have a combined balance sheet, combined cash flows, and it has played out really well for us. So we have consolidated everything into a single platform, which makes life much easier. We're able to offer multiple services to the customers in a single company rather than through a subsidiary and having different arrangements. Primarily on the import side, customers are shipping lines and freight forwarders, along with some large importers and exporters. And they have pan-India presence. So with this merger, we were able to offer them all our locations, in a much easier and transparent manner. On the cost side, also there was a lot of cost saving which we were able to achieve. Ranging from finance costs to operations, HR side. So that has worked out really well. Going ahead, we feel that this is our post merger. All our expansion in the CFS and ICD has played into one place, and we will be expanding in rail terminals going ahead. So it made sense from that point of view also.
Thank you. That really helped. So moving on. So you have given a flavor as to what you do and different services and verticals you have under your main company. But now I would want you to maybe further elaborate on the different verticals your company offers and what are the major metrics as investors we should track to analyze your performance in all these verticals. You may take your time and take one by one each of the verticals and we can go from there. Yeah.
Sure. So broadly now we have two verticals. One is the CFS vertical, container freight stations, and then the second one is the rail-linked inland container depot. So rail and ICD business is seen as one only. They go hand in hand. Um, Essentially, we're offering three types of services. One is rail transportation. So we are purely into EXIM business right now. We are not doing domestic rail, hardly maybe 1% from time to time for our existing customers. And this is basically going from Mundra, Pipavav, Navasheva ports to our ICDs and back and forth. Then we have road services. On the CFS side, road services are basically from CFS to port and back again for EXIM movement only. But in the ICD vertical, we're doing a lot of first and last mile connectivity. So once it reaches from rail from the port to our ICD, then we'll distribute it up to a radius of 100 to 150 kilometers all the way to the customer's factory and reverse for the export direction. And then the third is terminal services. So this is common to both ICD and CFS again. This would include general and bonded warehousing, specialized packing, labeling, palletization, temperature controlled warehousing, not different from how Snowman does it. It's more like an air conditioning room in Gateway rather than the -25 in Snowman. And other value-added services like garment on hanger fabrication. So these are special containers where we basically fabricate it in a way where all the clothes are loaded on hangers and it goes straight into a store if required. So we try to look for customized end-to-end solutions wherever possible, and that falls under this category. So essentially, those are the services and verticals that we have. On the second part, what you mentioned that what are the major metrics that we should look out for? So the largest one is of course throughput, the number of containers that we're doing, and that's measured in TUs, which is 20-foot equivalent units. So we measure what is the volume growth compared to us versus the industry, what our market share is. Along with on the rail side, we measure our turnaround time to measure our efficiency and how many TUs we're doing per train per month. And then we also track our EBITDA per TU, which is our margin per container essentially. So those are the important factors going into what an investor should look out for.
Thank you, Samit. That was really helpful. So I would now want you to maybe further expand on the Snowman Logistics business, because that is a business which we have, which is now an associate company of ours, and we are very, very bullish on our association with Snowman Logistics. If you can expand a little more on what are the workings there, and again, maybe you can go little back down the history lane, and from where did you first started looking at the company, and how it has been the journey so far, and what is your plans for the future? And also over here also, if you can share some key metrics, that would be very helpful.
Right. So we acquired Snowman in 2005. It was run by a gentleman in South India whose company was called Amalgamated Foods and Amalgam Foods and Mitsubishi and Hindustan Unilever. So we bought out the Indian partner shares and Hindustan Unilever shares, and Mitsubishi continued with us as a partner for a very long time. When we first acquired, they had two locations, the total of 7,000 pallets, and these were not the modern cold storage kind of units which are there in today's world. Yeah, it was more of a brick structure with some basic chilling equipment. But we saw a lot of value. We thought that there's potential in this market in India. And from there on, we've grown, over time. There was an IPO. There were multiple rounds of PE investment. IFC World Bank had invested. There was debt raised at different times. And with all of that, as a result, now today we are in 20 cities. We have 140,000 pallets. We are happy to say that, we are the largest in India. The number two competition which we have is at a much lower capacity, so we are able to maintain our market leadership out here. In terms of services, also we have expanded the gambit. So, like I said, it's ranging from +25 all the way down to -25 now. We cater to industries which are food related, like quick service restaurants, chicken, seafood, meat, all kinds of poultry products, ice cream, confectionery, pharmaceutical. There are even industrial products now like iPhone batteries and so on. So anything which needs specialized temperature, which should be maintained all throughout. And with the help of technology, we are able to give transparency to our customers. Uh, Even if a single degree drops at any point of time, they are able to know real time rather than knowing later. And apart from the pure warehousing and transportation services, we've also gotten into what is now called 5PL. So we do end-to-end supply chain management for some of our customers, which includes from procurement of goods right down to delivery and invoicing to their various outlets. So we going ahead also, we feel that there's great potential out here. And as you would have seen, we have been increasing our stake. And our plan is that as cash flows allow us, we don't have any set target, but we want to continue increasing our stake in Snowman Logistics.
Thank you, Ishan. So before I move to the next question, just a follow-up on, you mentioned that you are largest in this space, and the nearest competitor is very small compared to the scale at which you are. Can you give some numbers, some ballpark number as to what would be your capacity versus the capacity of, roughly, what is the capacity of the second player in the industry?
So we are at 140,000 pallets. In addition, we have some dry warehousing as well. The next competition would be roughly 50% or thereabouts. We have a lot of regional small competition. It's not to say that we don't have competition. At every location there are local players, but on a pan-India basis, we don't really have anyone large, and that gives us network advantage. So when large MNCs or anyone who's got requirements across the country, if they work with us, we are able to give them a solution which is covering any part of the country through warehousing and transportation.
Right. So now, for the benefit of the audience, I would want you to explain a few technical terms of your business in simple language. I think you have already explained one. I would urge you to repeat one of them, so that our investors, especially the new investors, they can understand the business better. So these are the terms I would request you to explain. Number one is TEU. You have explained, but you can probably expand a little more on that. What is TEU, just for the benefit of our audience?
So a TEU is a 20-foot equivalent unit. Shipping line containers, which are also called ISO containers, which are accepted everywhere around the world, and all the handling equipment is made to those specs which can handle ISO containers. Those are called TEUs, and there are two kinds mainly, which is 20 feet and 40 feet. There are some specialized containers, but majority bulk of the movement is 20 feet and 40 feet. So when we measure our throughput, or when shipping lines measure their throughput, if it's a 20 feet container, it's one TU, and if it's a 40 feet container, it's called two TUs.
Got it. So the next word or the term is, I hope I'm pronouncing it right, reefer.
Yeah, that's right. So reefer is refrigerated. Usually a container is called a reefer container, it's refrigerated container. But even reefer trucks, reefer vans in the context of Snowman. So reefer just means refrigerated.
Okay. So we don't use it in any, this is not a metric which is used in terms of capacity which we have.
I think it's
Capacity or like that.
yeah. So to be able to handle reefer containers, you need some electrical equipment like which is called reefer plug points. So the ports need to have them. Our ICDs and CFS need to have them if we want to handle reefer containers, because when they're not moving, then they need to be plugged in to maintain the temperature. And on our trains as well, we have specialized containers which we call power packs, which are able to charge the reefer containers en route.
Right. So the last terminology which I would like you to explain on is break bulk versus container cargo.
Right. So traditionally, all cargo which is in loose form, which, say, for example, cement or coal, that is transported in the world in what is called break bulk. So, it is uh, anything which is put on top of a vessel, which you can collect them. You have to handle the cargo itself. And over time, as I said, ISO containers came about, and uh, containerized cargo is anything which is put in a container. Why that helps is it helps in standardization of equipment, of transportation, around the world in the same sort of vehicles, vessels, trains. So containerization has really helped with international trade.
Even just to add on a safety point of view from cargo, when it's on waters, containers generally is a safer mode to transfer. Break bulk is used more for, say, things like food grain, fertilizer,
Steel.
coal. Yeah.
Yeah, and for the benefit of the audience, what would be the roughly difference in the cost when it is through break bulk and container cargo? I'm assuming container cargo would be more costly. The cost would be higher compared to break bulk, right?
No, actually, containerized cargo is, if the cargo is the kind which can be containerized, then it always makes sense to containerize it. There's a simple concept that, say you're an exporter from India and you send something in containers to a certain country. That container can be used to carry anything else on the way back, so it's fully utilized. Whereas if you have a specialized vessel to handle break bulk only of a certain type of cargo, then it has to come back empty. Or not every vessel or every truck can load the same cargo on the way back. Or say if you're carrying coal in one way, nothing else can be carried except coal on the way back, and you always don't get two-way cargo. So that problem is alleviated with containers.
Sure. So before I move to the next question, I see some of the questions coming from the audience. So please keep them coming. We'll take up all these questions towards the end of our session today. So moving on to the next question. So in FY23, I noticed the capex for our company jumped from a normal 50 crore to about 200 crore. So
Yes.
do you like to expand on this? What has
Yeah.
happened?
So this was basically on account of acquisition of ICD Kashipur. So this was a standalone terminal in Uttarakhand which came up for sale, and we were the highest bidder for it. It was previously run by a JV between India Glycol and Apollo Logistics. So yeah, basically it's 155 crores was spent on that acquisition.
Okay, great. And in our recent conference call also, we mentioned that our H1 FY24 volumes have come from Mundra, Pipavav, and JNPT in the ratio of 65-35. So I see that a lot of concentration is from the Mundra port. So how do we look at this ratio? Are we comfortable with this? How has this ratio moved over the years? And how do we plan to see it in the future?
So when we historically started Gateway, at that time it was known as Gateway Rail, we used to have almost an equal split of 33, 33, 33 between these three ports. Over time, it's become cheaper for the importers and exporters in North India to work out of Mundra and Pipavav purely because of the distance. And what Mundra and Pipavav also have an advantage since 2011 was that you can double stack containers here. So by stacking on the second, by doing double stack, you essentially pay 50% of the railway haulage cost. So there are cost benefits to working out of Mundra and Pipavav. But now with the DFC coming in, and hopefully by next year, by end 24, it should get connected to JNPT. That double stacking will become an option there as well. We have a slight advantage compared to some of the other container train operators because we have a pan India license. Not everyone has the license to operate out of JNPT. So it is a thought out there. We'll have to wait and watch to see what happens. But once the DFC is completed all the way to Navasheva, some more cargo should shift back to JNPT again. So we'll be in a position to take advantage of that.
So will it be fair to assume that this ratio will be normalized going further? Maybe we'll have more business from JNPT going forward.
We can't say how much because that's not our call. It depends on what the shipping lines do in their routing. But Mundra Pipavav will also be important ports. So we have to see how the ratio goes, but definitely GNPT volumes will go up.
Great.
And also,
Yeah.
we'll talk about our expansion in more detail, but as we look at more rail terminals, there would be some other locations which we are eyeing. from where JNPT would make more sense compared to Mundra or Pipavav.
Right. So moving on to the next question, I think this is one of the most important question today. So now I would want you to spend some time on dedicated freight corridors. So in the last few years, we have seen the government showing keen interest in developing this. It would be great if you can explain in detail for the benefit of all what exactly dedicated freight corridor is, number one. Then how the country will benefit from this. And then lastly, what role is Gateway Distriparks playing in this DFC?
Right. Yeah. So it has been, in the pipeline for a long time, and finally it's there till Gujarat ports now. Two dedicated freight corridors have been commissioned, Eastern Dedicated Freight Corridor and Western Dedicated Freight Corridor. For us, we are only near the WDFC. All our terminals in the north and Ahmedabad all connect to that one. And the three main advantages that we have from this are faster trains, heavier trains, and longer trains. So faster trains is that it can go up to 100 kilometers per hour, so it can reduce turnaround time and increase the efficiency of our operations. Heavier trains, when we started, there was a loading restriction of 61 tons on a double stack basis. Then it increased to 68 tons. But with the new wagons coming in that can ply on the DFC, it can go up to 81 tons. So it can increase the amount of double stacking and amount of tonnage carried per train. Again, that will be a cost advantage to both us and the end consumer. And then longer trains is a benefit purely for Indian Railways, where they can do Python operations and attach one train behind another. So with the same locomotive, they can carry two trains worth of cargo rather than one. So this is going to drastically reduce the cost of logistics, which is a big initiative the government has been taking, and also from a greener perspective, shift cargo from road to rail, which is another big target from Indian Railways to go from 25% to up to 40% in the next few years. With Gateway, the advantage that we have, we are the only private container train operator to have two ICDs in NCR connected to the DFC. Right now, our flagship terminal is at Gadi Harsuru near Gurgaon, and the other one is in Faridabad. So, Gadi has been double stacking since 2011, but it's been connected to the DFC since COVID. And Faridabad is connected to the DFC, but double stacking will only start probably coming quarter. So that would be a big advantage to us. Jaipur as well, which is under construction, is going to be connected to the DFC and is a double stack location. And Viramgam already is doing double stacking as well. So the main leg when it goes from right now, it's up till Sanand. From Sanand to JNPT, when that connectivity comes in, that'll be the next leg of growth for increasing cargo on rail as well as cost advantages for the end consumer.
Lovely. So I'm sure there are more questions related to dedicated freight corridors, but we'll take that towards the end. So I'll move on to the next question, which is related to one of your conference call. I think it was the last conference call, Q2 FY24. So in response to our participants' question in the last conference call, we mentioned that we will fully pass on the busy season surcharge to the customers. Can you expand more on this as to how easy or difficult it is for you to pass on costs to your customers? I mean, what kind of costs you can pass on and what kind of costs you can't? If you can.
So yeah, the busy season surcharge was a 10% increase in rail freight that Indian Railways came out with, and it's applicable for 9 months in a year. So we have all in our contracts with all shipping lines, exporters, importers, that in case there is a revision in Indian Railways tariff, then we will pass it on. There is a time lag in some cases. Some people require 15-day, 30-day, 60-day notices. So the gap might be there for some customers, but essentially after those 60 days also, we do pass on 100% of that cost to the end customer. So this is one that we are easily able to pass on. Another one is fuel escalation for first and last mile connectivity. We have a formula, basically a range for every 5 rupees of fluctuation up and down, you increase the rail freight, the road freight by X%. So that is also something we can pass on. Other costs we're not really able to pass on.
Thank you. Yeah. So now I think I will take a step back and I would like you to give me a picture of your growth expectations plus the size of the opportunity.
Sure. So, the way that we see, like I mentioned earlier, we are growing in a terminal business, a rail terminal business, and that's where we see maximum potential. So going ahead, the peculiarities of the land which we need um, is very specific for rail ICD. So you need to be next to a railway station. You need to have ideally 1 kilometer length. Then accordingly to the size of the business, you need the container yard space. So you're looking at minimum 20 to 25 as a small ICD. And that needs to be next to a hub where there's import and export activity and connected well to a highway for last mile and first mile deliveries. So with that challenge, land acquisition is anyway difficult in India, but when you get all these specific requirements, finding a piece of land which fits our needs has been a challenge. Having said that, we are currently looking at 3 or 4 locations, out of which we feel that we'll be able to finalize 2 very soon. Uh, why we want to grow our rail terminal business apart from the way that we've been currently doing our business is that we are hubbing and spoking. So the more we grow our rail business, which will feed into the same routes, the more cost advantage we have. To give you an example, when we started our Ahmedabad facility, which is at Viramgam, we are using it as a double stack hub location, which connects to Mundra Pipavav and JNPT. In the north, we have Gurgaon as our flagship terminal. So between Gurgaon and Ahmedabad, we can run, flat out shuttle services. It doesn't matter for which final destination it is, and we can utilize our trains on a double stack route on a DFC for the maximum portion of the length. And from the 2 points, it can then get distributed. This gives us the advantage, firstly, a cost advantage. We can double stack more because we can combine different weight mixes and combinations of 20 and 40 weight containers. And our transit times are better. Our commitment to the customer is better because we don't have to wait for a train to fill up before sending it to a certain port. We can just run these shuttle services. So when we grow at new terminals, we'll be adding it to the same network. So, we'll be able to, we'll have a much better competitive advantage compared to others. In terms of volume growth or financial growth, we are eyeing double-digit growth both at our existing locations, and then the new terminals will be a bonus on top of that. When we start new locations, typically it takes 1 to 2 years for volumes to ramp up, for the new ICD to be accepted by shipping lines, by the trade, by importers, exporters. But after 2 years, we see it will ramp up.
So any color on the competition as to when we are having these kind of growth expectations built in for our business, how do we see competition and how are we placed vis-a-vis the competition? If you want to share something on that.
Okay.
Yeah, so right now we are the leading player in the private space on the rail side. CFS has a lot of competition, especially in Bombay and Chennai, that there's about 30 odd CFSs in both locations. So that's become more like, whoever offers the best rate, it kind of business goes to them, uh, unless you provide some value-added services which are specialized. But other than that, competition in the rail space has decrease. There has been some consolidation. There are about 6, 7 large players now that we expect to see going forward. But still, as of from a volume perspective as well as a financial perspective, we are ahead of the curve.
Great. So now I'll move to something called pricing power. Do we believe we have any pricing power in the segments we operate? If yes, you can explain how.
So for the large part, the cost is decided. Firstly, the majority cost is the rail haulage, which is from the Indian Railways per kilometer charges which they charge. Like I said, we have a competitive advantage there because of our hubbing and spoking and the locations which we have. None of the other competitions are able to emulate this model as of now. Because of that, I would say we have some pricing power since we have a lower cost base compared to others. In terms of market pricing, more or less everyone is on the same page, and there's not much an individual company can change. Having said that, on value-added services, on first mile, last mile, on warehousing, there we have some pricing power because of our location advantage. And with some select customers who are large, who have been long term, who have a commitment with us going ahead also, we are very well entwined. So our ERP, is integrated with through API integration. Both the systems are integrated. A lot of work is done seamlessly uh, online, without any human intervention. So their supply chain is managed very well. And in those cases, we are able to charge a premium because at the end of the day, even though we are charging a premium, they are saving a cost on the overall transaction.
So if I
In Snowman, sorry, if I can just add Snowman also here. There we have definite pricing power because, like I said, we are far ahead of the competition, and our quality of services is, global standards. Since we cater to all the MNCs and pharma companies, we are very strict with our compliance. And for that, we are usually compared to the unorganized sector, so we have a definite premium pricing over that.
But when we look at the financials of Snowman, do you think that once you gain more and more control over the company, so you will work towards the financial? Because we don't see that in the numbers, as in operational efficiency is not visible as of now. If we look at the financial numbers, do you see that amalgamating with Distripark may give them that lever going forward?
So we're not discussing amalgamating, like we're not going to merge Snowman or anything. That's not on the plans right now. But Snowman numbers have improved quite a lot. We crossed 400 crore revenue and almost touched 100 crore EBITDA last year, which is a big improvement if you look at it from the last 3-4 years. The PAT might seem a bit subdued, but essentially this is because cold chain has a 150% depreciation benefit. So that's where that is coming from. That the accelerated depreciation, it's called 3580, which is making that number seem low. But EBITDA is growing strong and healthy over there, and we are expecting top line growth of over 20% going forward as well.
Thank you. That was very helpful. So now coming back to the answer which Ishan you gave regarding the pricing power which I asked. So if I understood correctly, our business is more about being the lowest cost provider and also being the most scalable player, right? Rather
Yeah,
than being a pricing power advantage, right? If I got
yeah,
it correctly.
that's a correct assessment. And the more you're able to expand, or the more you're able to grow your network and use the network advantage, the cost economics per unit keep improving.
So speaking about all these scale and cost advantages, now let's talk about entry barriers. You have some location or land advantage, I guess so. And how do you think about building on these advantages, or are there any other advantages which acts as a barrier to entry for newcomers?
So the largest one is your location and your land bank. You need to be next to the manufacturing hubs. And over the years, it's getting harder and harder, or is cost prohibitive. Even now, you can buy land at the right locations, but then the logistics business will not make sense. Uh, so, for example, in Gurgaon, when we first started procuring the land, it was a few lakhs. I think on an average, it was 4 or 5 lakhs per acre in the beginning. And that same place, the government acquired about 2 acres of the corner of our property for building a highway, and we were reimbursed at 10 crores per acre. So, right, 10. And that kind of pricing does not make sense for anyone to enter now, even if they were able to consolidate such a large piece of land. So one of the advantages is the location. Secondly, because we could see this problem arising in the future. So when we procured the land in the beginning, we purchased extra land. So for us to grow capacities at our existing locations where businesses are growing and where manufacturing hubs are located, we don't have any problem. We have that excess capacity available and at very less capex because all the services, all the rail lines, everything is done. So you just need to pave the yard and build more warehouses if you need to, and you can cater to more business. So that is one big advantage. The second entry barrier would be the network. So it is related to location and land, but it's also how you do your hubbing and spoking and how well you are placed with the dedicated freight corridor. So if we are to start a new terminal, we would like Kashipur, for example, when we acquired, we run shuttle services between Kashipur and Gurgaon. And Kashipur does not need to send direct trains to the separate ports, Mundra, Pipavav, and JNPT. Whereas competition or someone coming in as an entry barrel for them, they would have to deploy more trains and send them individually to each port. They will have empty running costs. They will have longer transit times or idle times while they're waiting for the trains to fill up, detention costs. So those are some advantages that we have, or which are entry barriers for us, for someone else coming in.
Great. So I think I have asked most of my questions, and there are quite a few questions on the chat box. So I'll take up them first now, and I'll refrain from taking questions which is directly uh, marked to a competitor or something related to completely projections about the next quarter or next year for the sanity of the discussion today. So first question is from Vineet. He asked, what is your opinion on innovation in the container segment for multimodal logistics like dwarf containers and Gati Shakti containers?
Right, so dwarf containers that came out, they're more for domestic purposes. Like Ishan was explaining that ISO containers are basically the standard ones that are 20 feet and 40 feet. Since primarily we're into EXIM only, we aren't going ahead with dwarf containers right now. But possibly in the future, we will evaluate once we build up more ICDs, more terminals across the country to get into the domestic business. As far as Gati Shakti containers, I guess it was meant Gati Shakti container terminals. So these are basically terminals built on railway land, either partially or fully. These are always going to be common user terminals. So whereas on our ICDs, we try to run only our trains. Long ago in Punjab, we used to work in a pool operation, but since then we've always operated everywhere on our own only, and that's where the a big chunk of the revenue is. So on an average container, about 70% of the revenue comes from the rail transportation piece, balance is on road and ICD. So we're not too keen on Gati Shakti container terminals right now, but we would explore as and when the tender comes. Because these are also ranging from 10 to 30-year leases. So short term, it doesn't make sense. But some of the longer term ones, if the location is good, and as Ishan was mentioning, that purchasing land is getting prohibitive in places, it can work out. So we'll evaluate them from opportunity to opportunity.
Sure, thanks. So next question is from Dhruv Ravani. So he's asking about, can you explain the entire piece of cargo movement in detail and what part of it cover, as in the DFC? He's talking about the dedicated freight corridor.
Right. So the DFC starts from Dadri, the Western DFC only we'll talk about right now. It starts from Dadri and it goes right now till Sanand. From Sanand, it goes via Indian Railway networks to Mundra and Pipava. And from Sanand to JNPT again will be DFC, which is under construction, and hopefully again by end of this year it should be there. So we are basically carrying it from our terminal, which connects to the DFC, the short feeder. Gadi is about 30 kilometers away, feed about 28 meters away. Then it goes on the DFC until Sanand, and then Indian Railways will take over from there. But for us, it doesn't make a difference as we just book it from end to end. So from our siding till the port siding, it's going to go. And we'll only look at the inland piece. Once it reaches the port, our job is over, and then the port operator takes over, and then the shipping line takes over. And as far as our Ludhiana and Kashipur terminals, those basically connect to our hubs of Gadi right now, and eventually through to Faridabad also. Um, and from there they'll get on the DFC because there's no direct connectivity to the DFC there.
Got it. So the next question is again by Dhruv Rabani. He says that I read that operating leverage is not immediate. Also that you can increase the TEU to 4x. But how should we look at operating leverage and when would you feel it will kick in? Is it primarily dependent on the export of the country?
It's a mix. So it's as the macro grows, it's not just the export. Overall trade has to increase. But as Ashan was explaining, we've bought land way ahead of its time. We have to take a 40, 50-year horizon when we're building these facilities. That's why we have to buy the land. Like Gadi, it's 90 acres. We were probably initially only using about 15, 20 acres. Today, we're still utilizing maybe 50, 60 acres, and we can optimize further. But we have to do it just because it gets cost prohibitive. And then, uh, as and when volume keeps increasing and we hit about 60-70% of capacity utilization, we're increasing our capacity there. So we have enough land bank right now to go on the rail side from current volumes of 350,000 TEUs, 350 to 400,000 TEUs. We can take it up to over 1.5 million TEUs.
And just to add, I think his question was also in the context of the DFC.
Yes.
So the operating leverage has kicked in to some extent, and we expect more benefit to accrue. Primarily in the form of transit times is where it has helped us. If you talk about pre-COVID, from Gurgaon to Mundra, on average, it used to be upwards of 50 hours, the transit time. And now it is, thanks to the DFC parts which have kicked in, it is about 36 to 38 hours. And just to give you an example, during COVID, when passenger services were not running, so even the normal Indian Railway was virtually a DFC, we were achieving times like 22 to 24 hours. So that is what we are hoping to get to once the full DFC is complete, and including movement to JNPT. As Sambit was mentioning, there is a possibility that shipping lines prefer to make more calls at JNPT after the DFC is complete to that point. So it remains to be seen how much of an operating leverage we will get from that. And thanks to the transit times improving, it's not just the ability to capture more business, but our cost per TEU goes down. So that is reflected in a improvement in EBITDA per TEU over the last few years, if you've seen. And in terms of the dependence on the export of the country, uh, obviously macro increasing helps volumes go up. But what we ideally want to achieve is a 50-50 balance between imports and exports, because that's the most ideal situation where our trains are running in both directions with the same amount of volume. There have been many years when it has been 50-50, but usually it is skewed in the favor of imports. And in today's time where exports are down because Western markets have still not fully recovered, and their buying from Asian countries has gone down. So right now we have more imports compared to exports. Uh, we are able to mitigate that to a large extent because of, again, the hubs and the double stacking, rather than running underframe trains, which some of our competition has to do.
And just to add on the turnaround time, just to give an example, we used to have 31 trains even 5 years ago. With those 31 trains, we could do about 17, 18,000 TEUs per month at a maximum. Now we're doing about 35,000 TEUs with the same number of trains. We've just added our 32nd train last month only. So that's direct function of the DFC coming in.
Great. So the next couple of questions is from our Mission Smile member, Mr. Jayesh Shah. So his first question is, with most of the logistics player offering 3PL services and a lot of them using Indian rail freight services for ferrying their goods. What gives GDL the right to win more businesses from new customers? The only difference currently between us and other players is we own trains currently and ICDs near major port. Is that correct?
So it is not correct to compare those businesses, these kind of businesses. What 3PL players are doing when they're using Indian Railways freight services, it is either parcel load or bulk cargo, and it is for domestic transportation. It is not for exempt trade, and it is not containerized cargo. So it is totally different business than what we are into. But I can just add on to the second part of this question. Having our own trains helps us, control the business and control the routes. But more importantly, owning the IC also, that is where we are able to do marketing, and that is where we consolidate the cargo, plus use it for the hubbing piece internally for our cost optimization. So if we didn't have our own locations and we were dependent on other private ICDs or now Gati Shakti terminals, uh, we would have the problem that we would not be able to park our trains anywhere. We would be marketing for other people's trains to carry the cargo as well. And here we are able to control the whole business.
So the capex is on the ICT side mainly, but the revenue is from the rail side. And then also, just in case some people confuse 3PL with freight forwarders, also just to add that freight forwarders who use rail services actually use service providers like us. So we are a lot of our business actually comes through 3PL and freight forwarders also on the international side, not the domestic side. And Another differentiator apart from just location is our technology initiatives. Do you want to
Yeah.
explain more? Yeah.
So, it is not just cookie cutter transportation that we do or warehousing that we do. Like I said, it's a supply chain solution that we offer to our customers, especially the larger ones. So in terms of technology, we were, while it is commonplace now, but we were one of the first to start GPS tracking of our fleet, which is not just, for satisfaction of opening the map and seeing where your cargo is, but it is for route optimization. It is for improving measuring the metrics and improving the costs. Uh, we have RFID enabled yards, so the stacking of containers and the planning of containers with least number of moves with the equipment, that is all automatically done. We actually have it is a catchword these days, but we've been doing this since about 2011, which is an AI/ML based route optimization for hubbing and spoking of double stack containers. Then there are smaller things like compared to a lot of our competition who has started later, or they don't have the number of ICDs or the network to justify spending so much in technology. So for them, for our customers to transact our physically go and do a lot of documentation, make the payments at the ICDs themselves, which are faraway locations. In our case, everything for many years now can be done online, apps, website. Even a lot of the customs procedures, the systems has given us the task, and we have pioneered even before any other government entity. We were the first one to jointly develop with them many digitization of documentation or of processes, which they pioneered at ours, they were appreciated, and then they replicated across the country. So those kind of things help with the customer service, apart from the transit times and the frequency of free services.
Thank you. So I'll move on to the next question of Jay. He asks, please throw some light on unit economics and how fees are levied in CFS and ICD business, as in how are the rates levied arrived upon?
Right. So on the CFS side, it's quite simple. It's just a handling and transportation rate which comes to and from the port. and then basically being stacked in the yard until it's cleared by customs, and then last mile is usually done by the importer or exporter themselves. In most places, there's a competition of ranging from minimum 5 up to 30 CFSs. So the markets are generally market driven. Rates are generally market driven, and you offer various volume discounts. On the rail side, it's a bit more complex in the sense that it depends on the distance, the weight, and the type of container. So there's a different rate for 20s and 40 feet. 40 feet is about 1.8 times the cost of a 20 feet rather than 2 times. And then if it's double stacked, that's at 0.5 times of the lower stack container. And then it depends on the nearby ICDs also. So normally the market leader takes the pricing since they've been established in the market, and then a little bit up and down 2000 rupees plus minus discounting takes place again depending on volume, distance. That's on the rail piece, which is about 70% of the revenue of a container on the ICD side. Balance is on last mile rate. That's purely a function of distance. And terminal services, again, you do it compared to the nearby terminals that are present. By chance, if you have a monopoly in a certain area, then you can levy a higher rate, but otherwise it's straightforward. Sorry,
Sorry.
you're on mute.
Yeah, sorry. So next question is from Mr. Jaideep Walia. So he asks, is there any probability of Indian Railways keeping haulage charges at low levels at the DFC in order to increase utilization faster than usual?
It's very hard to predict, actually. We can't really even answer that because even the busy season surcharge came at a sudden moment's notice. We had 1 day to levy it. It was done on September 30th, effective October 1st. But the idea behind the DFC would be that it lowers cost of logistics, and there is a body out there making representations of the associations that to help shift cargo from road to rail and make it a more greener way of transporting cargo, that rates on the railways are lower. So hopefully something happens on that side and we can take some advantage of that.
And there's another thought that, since the government has spent so much on it and it is all through debt funding at a global level, they would like to make returns on it. So if they want more utilization, then they would have to keep the rates at a good rate. There's also uh, a very good incentive, like Samvid mentioned, from the sustainability angle. So rail transportation is much greener than road transportation, and ideally, it's not one or the other. It's multimodal transportation, which is the globally accepted way of transporting cargo, and where India is currently lagging behind. But with DFC coming in, we expect more of that to be used, which means for the short legs, the road is used, and for as much as possible for the long part of the journey, you use rail. So keeping those sustainability targets also in mind and the funding in mind. We believe that, and we are betting our money on we're doing capex because we believe that DFC will be a cost competitive method of transporting.
Yeah, a follow-up to the question, to what you have said just now. Vineet has asked this question: how big is this opportunity from road to rail shift? If you can maybe put some numbers into it.
So the railway right now, the coefficient that's reported is about 25% that it goes on rail. Rest goes by road, little bit by uh, in coastal shipping and in waterways and air. But dominantly it's road sector. So the target is to take it up to 40-45%, but it'll take some time. It'll take more dedicated freight corridors, not just the western one, north, south, east, west. Um, there's other basically completing the full golden quadrilateral along with its diagonal. So it's a very long term project for that to happen. Along with policies like Gati Shakti will of course help the create more terminals, more rail infrastructure. even aside from the dedicated freight corridors, there's a lot of capacity being enhanced in terms of track doubling, loadability increasing on existing IR routes. So the opportunity is there, but it will take some time for it to come.
Right. So Vinith asks another question where he says, given all containers are manufactured in China, how do you see manufacturing of containers picking up in India? As this is important for us to be Atmanirbhar and make our industry cost competitive.
There has been some players who have started manufacturing in India now, but it's in a very small way compared to the gigantic factories of China. But for our specific business, it's not as relevant because the containers that we transport in the EXIM segment, the containers belong to the shipping lines themselves. So where a local player would own its own containers is for the domestic business, and it's a one-time capex. But obviously, it will help if we can get Make in India ISO containers. But for us, it's some time away, at least 5 years maybe.
Right. One question is from Mr. Hemant. He's basically asking when we make these capex plans, do we have any IRR or ROC in mind when we go ahead and do these capex?
Yeah, so we generally look at anywhere, depending on the project size, 15 to 20% kind of ROC, with a payback, maybe 5 to 7 years. Again, it really varies. And essentially, what changes and what drives that factor is the land cost. Everything else roughly remains same for a decent sized ICD of say 30 to 40 acres.
Got it. Vinith has another question. Can you elaborate more on specialized containers that are not ISO ones, and how does multimodal handling play here?
So these would be like the ones which were mentioned earlier, things like dwarf containers. There are some out of dimension, say 48 feet containers, and those are handled with the specialized equipment. So those are not, even though multimodal would play a role because in different countries there would be different kind of equipment, and some parts of it definitely on specialized vessels they can be carried. Specialized road vehicles, but it is definitely much costlier to use those containers. So typically it is done for project cargo out of dimension, large machines which cannot be broken down beyond the size, and they are very rare. And as Samir mentioned, dwarf containers is something which is domestically used in India, but it is not feasible to use those in terms of unit economics for international trade.
Most of the trailers are also designed in such a way that either you can carry a 20 feet or a 40 feet. So on a 40 feet, you can carry two 20 feet, but like three 12 feet containers. I guess you could theoretically do it, but then handling equipment of that is
Safety locking mechanisms.
yeah.
Yeah, so we are done with the questions of the audience. And before I move to the couple of questions which I have left from my side, if you allow, one of our Mission Smile members, Dhruv Ravani, he has worked a lot on this industry. If you allow, I can just, since we have time, we can just unmute him and he can ask a few questions. Is that fine with both of you?
That would be great.
Okay, just give me a second. I'll just unmute you. Yeah, Dhruv, I have unmuted you. You can probably.
Hi, Ishan and Samvid. Thank you for the opportunity. Just to dwell upon what I had asked on the operating leverage part. So before that, can you just update the status on the DFC? Like, what are the internal targets that you think that it will be connected to JNPT?
So Indian Railways is now, or DFC is now saying end of calendar year.
Okay.
I think actually they're saying it a bit earlier, but just to be conservative.
Yeah, just realistically, you feel by end of the year it will be connected.
Yeah.
Okay. So coming on this whole operating, so where I'm coming on, understanding the whole supply chain of cargo movement is that when you acquired that Kashipur thing, ICD, and I was just going to the con calls and everything. You mentioned that there are certain services which the other earlier provider was not providing, and we can give a holistic service offering. So can you just explain on that service offerings and what does that mean that, which differentiate us from 2, 3? So I think probably 2, 3 players provide different services and we provide combined all those services. So what is it exactly in terms of cargo movement that we look at?
Right. So earlier, this when we acquired this ICD, it was owned by Apollo Lodging Solutions and India Glycols, and they were only running the terminal. So they did not have a rail transportation business, and nor were they intending to get into that. So there would be other rail operators who would be providing rail services to that terminal. So what that meant was, firstly, a customer would have to separately deal with two entities, and any kind of pricing or discount would not be done on a bundle basis. They would have to buy those services separately and negotiate separately. So the cost was a bit higher for them. When we acquired it, naturally we would use our own trains and not other rail operators for this. So that became a combined offering. Uh, because of our network, like what I mentioned, from Kashipur to Gurgaon, we just run double stack services, and from shuttle services, and from Gurgaon to either Viramgam or directly to the ports, we run double stack services. So we were able to give that industry, the importers and exporters in Kashipur region, much better offering in terms of cost and in terms of how quickly their containers would be evacuated from the port in case of imports or from the ICD in case of exports. Whereas other rail operators, they would not have this luxury of combining come from uh, this kind of a network which we have. So they would either have to charge higher, or they would have to wait for their train to fill up, or only send a train when they collect 90. In a single stack, you can put 90 TUs, and in a double stack, 180. So, say there are 60 TUs worth of customers waiting for their cargo to be exported. That rail operator might not do it because running 30 TUs under frame is a huge cost. Whereas in our case, we can bring those 60 in a very short distance to Gurgaon and then connect to any of our other trains. So
And
that was a big service offering.
And there were about 3, 4 train operators there, so volume was being split. With us, it's just one, so coordination is a lot easier for the end customer. And we were also offering now first and last mile from Kashipur, which a third entity was doing before we came. So actually, it was 3 entities you had to deal with to just move a single container.
Okay, so just looking from a customer perspective, so there are basically 3 offerings which a customer has to take care of.
Yeah, rail, road, and ICD services.
Okay, so we provide even the road part of it now, in terms of the last mile thing.
Yeah, we've been doing that since the beginning at Gateway, but Kashipur, after we took over, we brought it under like a end-to-end solution.
Okay, okay. And is there any offering do we also provide just the rail service to someone at some another terminal if they want currently, or we are just providing only integrated services on our ICDs presently?
On our ICDs, we are working out of some third-party locations, but that's not an ICD. It's basically transportation of empty containers to another place, and from there, some export containers go there, which helps us in imbalance situation. But that's hardly 5% of our business.
Okay, okay. The second question is, what would be the capacity utilization of our existing train sets? I know you have 31 and you just added 32. So this is more from understanding where you would like to, then add it. So what would be the
Yeah.
capacity utilization currently of your train sets?
So we had hit almost our peak with 31 trains. That's why we decided to add 3. Now we've added 3, and these are all higher capacity, which can take 81 tons. So we can double stack more on this once the network is complete end to end, like the upgradation is done. And also these are higher speed trains, as well as instead of 90 TUs, they are 96 TUs. So 6 more TUs on single stack basis, 12 on double stack. So slight advantage there as well. So we are adding 3 now, and these are available on a 6 month basis, whether to buy or lease also. We can do it on a short term basis. So as and when we're hitting 90% utilization, 95% utilization, we look to add a couple of more trains then.
Okay. And
Also, it goes
yes.
along with the network expansion.
Okay, okay. And all our ICDs, including Kashipur, currently have a rail terminal there.
Yeah, all ICDs are railway, all CFSs are roads.
Okay, perfect. So coming to the ICD part of it and understanding the unit economics. So ignoring the land cost of an ICD on the capex side, what will be the capex of a ICD if you want to put it in a per acre basis or how you want to put it? Ignoring the land cost.
Rather than per acre, I mean just like a rough one in our Jaipur terminal, in 30 acres, we are targeting a capex of about 90 to 100 crores, out of which land cost was 30 crores.
Okay.
So it depends on how much warehousing you want to put in, how many rail lines you want to put in. A big factor is how far you are away from the railway station where you get connectivity from. So that cost can go anywhere from 5 crores to even 30 crores if you're further away from the railway station and it's a busy traffic road, because then you have to create an additional loop line. So there are some big factors. It's not as standard as each ICD has a similar cost.
And so the siding or the rail siding, which is not on the IR line, that has to be maintained completely by us on all these ICDs, or it goes to the Indian Railway. Like how does the maintenance and everything of that work, including the operation?
Inside inside the terminal is our responsibility. Outside the terminal is Indian Railways responsibility.
Okay, so although we will be build the additional railway line from the main railway line to our ICD, it will be maintained and operated by Indian Railways. Is
Yeah, so built on usually railway land itself. So we lease that land, we pay railways to do this, and now under the new policy, suppose we build a fresh loop line and we're building common user infrastructure, then there's a rebate policy also that you can apply for putting that capex. Until you recover that capex back, you basically get a discount on your rail freight. So essentially, it's free capex, but with a time lag. So but still, that wasn't there earlier in the old policy, so it's a benefit to us only.
okay, okay, understood. And can you just give more color on the warehousing opportunity that you're looking at, because which I think which is apart from the ICD business that you're looking specifically at warehousing opportunity also. I'm not talking about the Snowman business, on the gateway business. Is there any warehousing opportunity or a vertical that you're looking at out there?
No, so in Gateway, all our warehousing is linked to our business of containers. So we provide space for, like I was mentioning, garment on hanger facility, temperature control facility for alcohol storage, other value-added services,
Import on.
bonding, consolidation. So it's all linked to that. There won't be any separate warehousing vertical. Whatever warehousing is happening in our group is happening at Snowman. If you're interested in that, we can speak about that.
Okay, okay. And just was curious that currently we are only on the EXIM opportunity, but with the DFC coming on board completely, suppose you have a pharmaceutical company out there in the north or a Maruti car which needs to be transported to the western part of India on, can that opportunity also happen, which is domestic, and would we want to participate in that, or you feel no, that is completely different?
No, we are okay, and we can run mixed trains, and this is where Viramgam advantage can come in, that we run a mixed train from say Gadi to Viramgam, and domestic can get last mile distribution over there. The problem with domestic right now, especially on this northwest route, is it's imbalanced, and these will be on our own containers. So we can do one way loaded, but return we'll have to bring back one way empty containers, which no one will pay us for really. So once in a while we do spot movements, we do cabotage movements, which is where we use an empty container of a shipping line and fill that up with cargo. But again, that's less than 10% of our business right now. It's a very spot market kind of business.
So how would that market be currently catered to? Is it completely by road?
A lot by road. There are some people who still do it, and Concor and other people who have actually mainly Concor only, since they have a wide network. They can triangulate their trains anywhere, and so say they can move it Delhi to Gujarat, and Gujarat say they can send it to Nagpur, then Nagpur to Indore, and then bring it back to Delhi. Like so, wherever they get the train route, they can do that. We don't have that flexibility until we add say 5, 6 more terminals and expand to different regions in India.
So where do you feel like, if I have to look at the 5-year view specifically, where do you see, like, would we only focus on the EXIM thing, or like what would be the growth triggers in terms of volume? Would we have to restrict ourselves to EXIM, or just trying to get a color on what is your vision internally that you feel on the 5-year view, if I have to put it?
Yeah, so right now we're focusing on Jaipur and then two more after that. So that should probably take us 2, 3 years to do that. After that, we'll probably continue expanding on the ICD side. 3 years is actually a long time in our industry where the dynamics can change and we need to reevaluate then. But the plan is to get into domestic eventually. But for now, all our projections and all our plans are exim focused only.
Okay, okay, fine. Thank you, Ankit, for the opportunity. Thank you.
Thank you. Thank you, Dhruv, for some really good questions. So I think we have a hard stop at 5:30. So I'll just take one last question from the audience and then I'll ask my final question. So I think Vineet asked this question. There are also new solutions like triple stacking that RDSO has been testing on WDFC. How feasible are these and does it further optimize the costs? Is this question.
Once again, refers to the dwarf containers. Triple stacking of ISO containers is not being done in India, and I think even globally there are some tests here and there, but it's not considered safe. So this doesn't really apply for us also. And again, dwarf containers is not something which we are currently interested in. As Samit mentioned, it might make sense in the future for domestic movement, but for EXIM, it doesn't match with the international standards.
Great. So I'll just ask one final question, which is a pretty open-ended question. Where do we see Gateway Distriparks in the next 10 years?
Tough one to envision 10 years. Actually, it's so dynamic and everything's changing really fast. So but the plan is to keep expanding on the rail side, as I was mentioning. So the next 5 years, I think we're going to continue focusing on EXIM, but thereafter we do have plans long term to become a full-fledged rail operator, which means that right now we're only doing container wagons, but we would also evaluate. AFTO is an auto freight train operator, which is for finished car vehicles. There's a emphasis on shifting instead of road carriers to rail carriers there as well. Bulk wagons, special purpose wagons, this is also on the cards. But we need to have a network in place for that. And also just to continue expanding our end-to-end solutions as much as possible. That's on the gateway side. Snowman side, if you want to go.
Yeah, similarly, right now we're on a trajectory where we are growing cold storage capacity by 2 to 3 facilities per year. And that is separate from our asset-light model for the dry warehousing. So we definitely will continue with being the market leader in cold chain, but we expect a big jump to come in from a consumption story in India. And definitely will be more than doubling our capacity in 10 years. And I think, like Samvit said, even 3 years is a long time for us. So to talk about 10 years, we can only guess right now what path India takes. We are very excited and we are very positive in our thinking that India is going to grow in a big way in the next 10 years, and we would very much like to be a part of that. And on a lighter note, in 10 years, maybe we'll be doing the 10th episode of the show with you.
Thank you so much. So I would like to thank all of the audience who attended the session and asked some really good questions. And I would like to compliment both of you that the way you both complimented each other in today's session, I'm sure you are complimenting each other in the business as well. And we wish you all the best from our side. We may the business of Gateway Distriparks grow from strength to strength from here. And thank you so much for spending your valuable time with us. And I'm sure as a community, we at Mission Smile have learned a lot from today's session. Thank you so much. We'll share the recording as soon as possible. Thank you so much, everyone. And thank you so much,
Once again for having us, and thanks to everyone for taking out the time to participate and for the great questions. And to everyone who has participated or who's going to be listening in the recording, if you want to get in touch and find out more, we are always available.
Thank you so much, Ishan and Samvit. Thank you.